Welcome to this short video on incentivising management teams in buyouts. I'm Duncan Skailes and I'm joined by my colleagues Workman and Nick Tilley. It's interesting to observe over the last 10 years or so how this market's changed. In the past, this advice really only attached itself to much larger transactions in the hundreds of millions or billions of pounds. But what we've seen recently is that all deal sizes, right down to the small end of the market, now get the full suite of commercial, financial and tax advice. In addition, whilst the market was led by private equity, other asset classes such as infrastructure funds and real estate funds now are also embracing the same techniques as they too try and help managers change from being employees to being co-owners in a business. And there's some important detailed points that really impact managers that have crept into the market. So for example, in the past, management teams got the commercial value of their shares either at completion when the deal closed or over a period of time when, over 2 or 3 years, when the vesting schedule kicked in to incentivise managers. What we've seen recently is that other criteria are also being embraced to impact when managers commercially get their shares. So for example, the meeting of cash flow targets or profit targets can also impact this so-called performance vesting schedule. Finally, there's new types of capital that have come into the market, most notably the patient capital we've seen from pension funds and from sovereign wealth funds. And these can have some important impacts on managers too.
Yeah, so just picking up on that patient capital point, Duncan, we've worked on a few mandates recently where that patient capital profile has had a real impact on the deal structure. So what you have is a mismatch between the investor realisation of the investment and the management exit, where they're looking to get their returns in a shorter time frame. So what we're having to do is structure in synthetic exits for management, so factor in put and call options to allow them to realise their value. And in doing so, we're having to work closely with Nick's team to make sure we get the tax treatment right.
Well, exactly. So the key here is that management team members obviously have invested what can be a significant amount of money into an asset they believe is a capital asset, leading to a capital gain when they liquidate it. So if that synthetic exit structure is not done correctly, the worst that can possibly happen is that then would be taxed as earnings with social security costs and income tax and all the rest of it, wherever the tax residence of the managers is. And the interesting thing is, in parallel to that, the sort of performance vesting that Duncan made reference to earlier can end up with a similar result, again, if you don't get the structure right. So the interesting thing from my perspective is that we start off getting involved in the intricacies of all these little details from our various areas of expertise, but by the end of this process, the management team members we're advising are basically just happy that they've had somebody like us standing alongside them the whole way through to advise them on a process they just did not get from the start.
Yeah, and I think what we're increasingly hearing, Nick, is that the management teams appreciate having the full suite of tax, legal and corporate finance advice all joined up as one.
Yeah, so that one-stop shop really can then be complemented by 2 other things really. The subject matter experts we have in the firm who can bring to bear if it's relevant.
Yep.
And if there are team members outside the UK, then our international network can complement the UK presence and serve those guys as well. So if you have any queries on incentivisation of management teams in buyouts, or you have a situation you want to discuss, please don't hesitate to get in touch with any of myself, Nick or Pete.